Good evening, everybody. Happy Thursday. Kamari Ellis here. Welcome to the Finance Rebel Show. Today we got a special guest, and we're going to be talking about a subject that I usually don't talk about. But today we're going to be talking about credit, and today we're going to be talking about credit with Miss Terri Couser of Care Credit Tools. I always get tongue twisted on that one. But yes. I wanted to talk with Terri because we kind of have a similar outlook and feeling on credit. She's definitely more of a credit advocate than I am, clearly, because she works in the industry in that profession. But we both realize that it's important, and there's some other things you need to have and lined up before you truly can maximize your credit and use it to build wealth. So today we're going to be talking all about how to use your credit to build wealth. So feel free to chime in, ask any questions. That's what we are here for. And feel free to like, comment, and share. Again, like, comment, and share. Share this out because we're going to have a lot of good information, and a lot of people could be benefited or blessed by some of the things we talk about tonight. So good evening, Terri. How you doing today?
I'm good. How are you?
I'm good. We had a little bit of difficulty, but we got it together. We are here now.
We worked through it.
So here's a question for you right off the bat.
All right, here we go. Hold on.
What's better? Is it better to have an 850 credit score or $100,000 in the bank?
So you know what? And I'm not even going to play these games with you because it really depends on who you ask. That's the real answer. Well, I say that you use credit as a tool for leverage. And so, my standpoint is that if you have capital, why use it all if you really don't have to? But more importantly, if we're talking about servicing and helping the majority of the public, most people don't have $100,000 just sitting in the bank. And so one reason why I'm so passionate about what I do is because there's more than one way to get to a goal. Most people don't just have the money sitting in the bank. So I don't think that people should not be investors or not fund their dream or not be able to buy a house just because they don't have $100,000. I'm a firm believer in then let's create a plan and leverage what you do have to help you build.
That wasn't a fun answer.
That was a straight answer because I mean $100,000. What do you want to do with it?
So
what do you want to do with it?
So you can do a lot with it.
I know you can do a lot with it, but how many people have $100,000 in the bank?
No, but how many people have 850 credit score? I mean, we can go back and forth with that, right? So I'm gonna tell you.
But I don't even need you to have an 850. You can have a 680, and I can still get you some stuff.
I had to redefine the question. So I see that meme very often. I've even put that meme up a lot of times, and
I've seen it often.
Yeah, and so I have my take on it. I think it's better to have the $100,000 personally. A lot of people feel that credit is more powerful than cash. The first rule in finance is that cash is king. Nothing else is more important than cash. But a lot of people don't follow that axiom, don't believe that axiom. They believe that credit's more important. So that's why I thought it was really cool that you and I could get together and talk, because at least you have a perspective that credit isn't the end all be all. And it's really more of the entire mix of you should have some cash and you should have some credit in order to leverage and truly create wealth for yourself, your family, and your community.
I agree. And let me just say this. So there are the Dave Ramseys of the world who cash is king, have no debt. And then there are the Robert Kiyosakis of the world who are leverage, cash flow quadrant, use other people's money. Now, I would challenge you that they're both wildly successful. They both make a ton of money, and there are people that follow both plans. But the population that I service and the most of the people in my immediate network don't have just $100,000 sitting down. So I do believe to be an investor, to have a business, you do need to have some type of capital. But I really think that the smartest way to utilize it is having some of both. Have some capital and also leverage having good credit, period. There isn't one way to get to the end goal. A smart person diversifies. So if you diversify in everything else, why wouldn't you diversify in your strategies? and have credit and also some capital.
Okay. All right. I like it. I like it.
You like it?
I like it. I'll take it. We can work with that. We can work with that.
All right.
So now that we got some shenanigans out of the way, tell me why. Tell me a little bit about your background and why you chose to do this.
Okay. So my background is that I actually worked for a national credit bureau. So the reason why I point that out is because there's actually a lot of people out here, and we've talked about it, who are doing credit and call themselves credit specialists. And they did an online course. You like that? The air quotations. They have done an online course, or they've watched some YouTube videos, or they've done some things and got a few little results, and now they call themselves a specialist. Well, I've actually updated tens of thousands of credit reports across the nation and was trained by a bureau. So originally, real estate corporate America was my path. But when I started having the seed for entrepreneurship, I started thinking about what knowledge, skills, and experience do I have that can fill a need, generate income. What kind of skills do I have? And it's been credit. And credit has been something that has helped me through my entire life. And I don't mean like I'm some big millionaire right now. I would be lying to you if I said that. And I'm very transparent. But as a single parent, there are times where credit has been me being able to get a vehicle or do repairs on my house, me being able to get a house, me being able to invest in my business. So me having credit knowledge, I use that as a platform to build into income producing items. And so this is why now you get the knowledge, you do it, you reach back and you teach other people. So it's all about, for me, it's about empowerment, giving back, and because it's a very predatory field. I see a whole lot of nonsense of people getting scammed. So I'm very, very big on the education and the empowerment piece. Whether you use me or not, if you've been to a seminar, I've been to a workshop, I really pride myself on giving transparent, good information so that you're not getting scammed, you're not paying money, you don't have false hopes about what credit really is, what it takes to be approved.
Right. So you've actually worked at the bureau.
Yes, I also went to real estate school and did zoning, and I have 2 degrees.
Oh, okay. You flossing.
No, listen, you asked me.
Right. Well, listen, you are supposed to be proud of those things. And
Amen.
So what are your degrees in?
So I have a Bachelor of Interdisciplinary Studies with a concentration on leadership from Villanova University, and I have a Master of Science in Human Resources Development from Villanova University.
Okay, so you know how to deal with people.
I know how to deal with people. I know how to manage. I know how to quantify results. I know how to be professional. I know how to help other people and build relationships.
So it's funny that you have HR background, because actually next week, this is a great segue into promote next week's show. Next week's show, we're going to have Dominique Thompson on to talk about how to run your business and with HR. That's a terrible segue. But we're going to we're going to tell small business owners why HR is important to your business. A lot of us are not thinking about HR, and a lot of us are not thinking how to work with contractors and employees, because a lot of times I get folks who think everybody's a contractor.
Right.
But in actuality, they're really an employee, and they don't really realize they can be fined for that. So next week's show will be fun. So come back 7:00 here next week. So, okay, Terri. So you are the credit maven, the lady that's running it all. You're passionate about it. You want it seen done right. Right. And so what's the process for this? I mean, I see people say they want to get deletions off their report. You got to write letters, the dispute reports with the credit agencies. Like, give us a breakdown of what the actual credit industry is and how it works with the individual, like FICO scores. I think FICO scores are a scam. And explain all of that.
Yeah, so you said a mouthful. So first, let me start with dispelling some myths, because honestly, everybody just says dispute. I just was on the phone with one of my lenders today, and we had a long conversation about a credit file, and there was a bunch of accounts that were in dispute, and she could not, even though the person, and this is like a conversation today, the person had a 675, a 680, and a 650. So the medium score was 675. So we're good. Our goal was 660. They could not approve the mortgage because there were accounts over $1,000 in dispute. I'm actually going to be doing a video probably tomorrow or the next day that's going to quote some of the laws some of the lending guidelines that talk about accounts being in dispute. Because people are thinking you just go ahead and write a bunch of letters, everything gets deleted, and you have perfect credit. False, false, and more false. Because if that was the truth, everybody would have perfect credit. And so what I do when I'm working with my clients is I'm strategic about what's on their file, what needs to be done, where are they weak, what kind of credit are they trying to get? Because your credit file needs to look different if it's going to be a home equity line of credit, if it's going to be a mortgage, if you're trying to get a credit card, if you're trying to get a business loan. So it matters what the end result is, and then as far as matching up with your credit report. And so all of these blanket things you do to fix credit, false, false. Look, can you see my hands? False. Because, what needs to be done on my credit, what needs to be done on your credit is completely different because I don't know what it is bringing your score down. Is it late payments? Is it charge-off? Is it bankruptcy? Is your debt-to-income ratio? Is it too many inquiries? Are you buying trade lines that have a bunch of authorized accounts? I know about it all. And guess what? If I know about it, the lenders do too. You're not fooling anybody. Listen, one of the reasons why I get the results that I get, and one of the reasons why people call me a credit expert and you see me very visible is because there are credible businesses, lenders, people like you on my network that endorse me because I give good information and do it the right way. If everybody is buying authorized trade lines, you don't think that the bureaus and the lenders know that? There are certain guidelines that too much of your credit report is a bunch of authorized accounts. They don't count it at all. So would you rather pay $2,000 to have an authorized account added to your report, or would you rather invest in credit repair, do some work the right way, and have real credit the right way, and be able to get to your end result? It's a bunch of baloney. You don't have bad credit for 5 years and want it fixed in 30 days. It doesn't happen that way.
Yeah, but nobody's got time.
I got time for that.
They want it quick.
Well, listen. They want it quick, but I can say this: if you have, negative credit, depending on what it is, can be reported for 7 years or can be reported for 10 years. Can you be committed? Can you be disciplined? Can you change some behaviors and work strategically for 6 months, 9 months, 12 months to get to your goal? If you're serious, absolutely. There's no quick fix, and anybody who promises you a quick fix is telling you a lie.
Okay, so there's no quick fix.
Now, it can be done quicker. Sometimes you can do things in like 90 days, 30 days, 60 days. But again, it's all relative to what you're trying to actually accomplish.
Got you. All right, everybody, y'all heard it. Be sure to like, comment, and share. Like, comment, and share. Share this with your network. Share this with anybody who you think might need help with getting their credit repaired properly and not getting a quick fix. But, going back to that, most people don't want to do it slow and right. They want to do it fast and inaccurate. Because everybody's trying to get the buck, or they're trying to get into this new home, or they're trying to get the new car because they want to get to work and be able to go out. So, what do you say to all that? I know you kind of talked about it, but when people push back on you, what do you say?
Well, I don't have conversations with people that push back with inaccurate information. I spend time educating them, and I tell them you're welcome. Okay. But no, if there was a way to make it happen inaccurate with the wrong way, then everybody would have homes. You can't trick, underwriters and mortgage lenders and people that are giving this bigger money. There might be a couple of tweaks that need to be done. Well, then you may not need full credit repair, but it probably wasn't that bad. But if we'll go with home ownership. More goes into it than your credit score. So when you're working with somebody like me, who is an expert, who works with lenders, who knows what the full package looks like, I'm looking at, one reason why I reached out to you. I needed a good tax guy for my clients because having their taxes part of the approval process, your debt to income ratio, your student loans, your bank statements, your verifiable income. So what? You have an 800 credit score and you have $300,000 worth of student loans and you make $40,000 a year. Well, guess what? You're still not getting a mortgage because your income doesn't support your current debt and then the debt of the house. So the reason why I say is stop using all these fake people, because you're spending money that you could have invested to pay down your debt the right way, to be strategic, to rebuild credit, to hire somebody who's really going to give you a real strategy and really get the result. When these people use amateur services, they get amateur results. And that's why they're still 2 and 3 years in and they don't have their house. They don't have their business. So you may have somebody that says, oh, I got an inquiry deleted. Oh, I got a collection deleted. Okay, where's your house? What did you really get? So you spent, $1,200 paying $100 a month for a service. I won't name any names, but you paid $100 a month for 12 months. That's $1,200, and you got a $300 collection deleted. How smart was that?
So tell me something. What is a FICO score?
So really, it's just a name, to be honest. Scores are scores are scores, and I could talk for 2 months about credit scores and not give you all the information. All a score is, period, is a criteria that lenders use to approve or deny credit. There's Banker scores, there's Fair Isaac scores, there's all these different names. All they are is scoring systems or scoring models, but FICO score is probably used by 98% of lenders. But I actually want to say something to you about that. So you know how there is, and people don't even get it, there's even different versions of FICO scores. So this is why I tell people, they walk around, they say, I'm a 700 credit score. No, you're not. Because of what? Because Credit Sesame? Because of Credit Karma? Like, stop playing. Your real score is actually calculated when a lender pulls your credit file. So any kind of third-party score is just a guide. This is why I'm so big on education and so big on empowerment, because if you do the right activity on your credit report, your score will go up as a correlation. So Freedom Mortgage can say your score is one thing, and Wells Fargo can say it's one thing, and Bank of America can say it's one thing. They could be using different scoring models, and then obviously if it's a mortgage, they're going to use all 3 credit reports, so your scores are going to be different based on which report also. So again, it would behoove people to spend the time to actually just do the right activity on the credit report, have financial, credit stability, be credit worthy to lenders, and then get the results and have long-term financial stability.
So what exactly is the right activity?
The right activity is paying your bills on time, not maxing out your cards, not having multiple inquiries, not spending your money frivolously on things that depreciate, not having a bunch of, I can go on. There's a lot of right things to do.
Keep going. Keep
going. So, honestly, when we talk about the topic, using credit to build, my main thing, if we're going with that theme, is that how can you leverage credit to put it into things that are income producing? And we talked about this. I am very into multiple streams of income. So let's take $40,000. Putting $40,000 into buying a car, okay? And then depreciates, you're spending maybe $50,000 at the end of it. And what do you have? What is your asset? What do you actually have after that? Or somebody else using credit the smart way, taking $40,000, and let's say they invest it into their business. Let's say they invested in getting an LLC in their website and having products or a service. And let's say at the end of the year, they make $60,000. Now that $40,000 yielded $20,000. They can pay back that debt, and they also have something, they have a net. Whereas though in the first example, you spent $45,000, and what do you have? In the other example, you used it wisely and you generated some extra money. So really, honestly, and I see your nod, but let me just say that the difference between, wealthy people and people who are not wealthy and leveraging credit is what you spend your money on and how you pay it back. That's
right,
it.
Part of the reason why, I asked you that question is to really address some of the quote unquote, you did the double-handed quote unquote myths out there, because a lot of people think and feel like, if I get my credit score up high enough, everything's golden. They're not thinking about anything else, but they don't realize that there's multiple credit bureaus, there's multiple, like you said, multiple credit scoring models.
Correct.
Then on top of that, the lenders didn't have their own personal models or their own models based upon
You're absolutely right.
What's being done. So, I wanted to talk about that a little bit, because, again, we talked about this earlier, there's so much misinformation out there.
There's a lot of misinformation.
Yeah, earlier today, I saw somebody say that the president of the United States works for the Federal Reserve. And I get it, everybody's got a conspiracy theory, but technically the president appoints the Federal Reserve chair. Now, I don't have time to go back and forth about what's the conspiracy theory about what's real, but
right.
At least in structure right now, the president appoints the person to run that organization.
Right.
So it's hard to say, where'd you get that from? And I asked him, and They couldn't give me any real concrete evidence. And so part of the reason why I do this show is to like real concrete evidence. And so to say, no, that's not true. That's not true.
No.
Where getting your information from? So that's why I asked. And we're definitely going to talk about strategies and techniques and tactics on how to build wealth. So,
well, let me just expand for one quick second too, is because what you said is absolutely right. Number one, different scoring models. Number two, different versions of those scoring models. Number three, different credit bureaus. But also number four, even when the inquiry is done, the type of lender they are matters. So your TransUnion credit report, your score may be different if it's a mortgage lender pulling it, an auto lender pulling it, or a credit card company pulling it, because they all have their own individual criteria. So this is why, you know, these little nuances, they really mean a lot. I've had people look at Credit Karma who uses Vantage scores, and then I have a lender pull their file and it'd be 50 points off. 50 points is a huge deal. A huge deal, and sometimes it's more, sometimes it's less. And so this is, again, there's I agree with you 1,000. Look, we agree on something. There is a lot of inaccurate information out there, and so this is why I really pride myself on education and empowerment.
Okay, so there are a lot of different credit models out there. So your recipe for success is pay your bills on time. Right, but what if you're like a credit? What if you're like a government worker, right? And you shut down, you've been furloughed. So, do you have any leniency, and how long you can pay before you get dinged on your credit report?
Yeah, absolutely. Good question. So, I mean, honestly, so they cannot legally report you to the credit bureaus until you're 30 days late. So that's number one. And so the reason why I actually say that is because people don't understand. So back to credit strategy, you may have your Pico bill, your life insurance, sorry, Rashawn, your water bill, other things that are not on your credit, your cable. And then you have your card note and you have your credit card. So people automatically say, let me pay my Pico, let me pay my auto bill. Now, I'm not saying don't pay your utilities. That's not the message Terri is saying. But what I'm saying is that credit is about looking good on paper. Why are you looking good on paper? Because you're trying to get money, you leverage other people's money. And so you have to play their game. So when things are tight, make payment arrangements with the things that are not on your credit report. You know how many times as a single parent that, I had, got laid off or something happened and I did not have all of my money? Well, guess what? I had to pay my card note. I paid half with one paycheck and half with the other paycheck. I may have gotten a late fee. I may have been late in their system, but I was never 30 days late for it to hit my credit report. So my credit report looked perfect because I split it up and did as much as I can do. The other thing is, like, let's say you have 5 credit cards. Okay, say money is tight. Why on earth would you default on all 5? Let's say you have to strategically sacrifice 2 or 3. Look at which ones have the highest limits. Look at which ones you've had the longest. And maybe you genuinely just do not have the money. Some of these minimum payments are $25, on some items. It depends. So maybe you say, all right, I have 5 cards. These 2 cards that have the higher limits that I've had the longest, no matter what, they are being paid on time. You may have some late payments or something else on the other ones, but at least you did not let everything on your credit report go completely down. So when you're in the process of rebuilding, number one, you'll be able to explain. Number two, it's going to be faster for you. And then also talk to your creditors. They know it's a government shutdown. You'd be surprised how many creditors have different programs, have different options, will put a payment at the end of the loan. One of the things I try to tell my clients is be empowered to pick up the phone and have a conversation. I had before, there was a time when I single parent, son was young and got into a car accident, a really bad car accident. I was out of work for a while because I had not been at the job for long enough. I did not have like a whole bunch of, like paid time off and all of that. I called my car company and said, listen, I was in a car accident. I don't have the money. They didn't give me a whole lot of leniency, but they put that one car payment on the back of the end of the loan, and I was okay. It never hit my credit report. So have a conversation with the phone.
Make sure. So let's say card note's due today, it's January 16th. It's not going to get reported to the credit bureaus until February 16th, right? Is that correct?
Yes, okay. 30 days. They cannot legally report you until 30 days.
Okay. And if you do run into hardship or trouble, you want to call. You don't want to be shy. Now, a lot of people have pride, right? They don't want to admit that they're going to be late or they're short on the money. I mean, how do you deal with that?
You don't. You have to get over it. Get over it. We're adults. Life happens. What do you want me to say? I'm not going to sugarcoat it. You need help. You have to ask for it.
So you ain't in the hand holding. You just give it to them like it is.
No, listen, we are adults here, all right? Life just got real, okay? You got bills, you don't have any money. Pick up the phone and stop playing. Would you rather pick up the phone and have a conversation, or would you rather have a late payment for 7 years and your score drop 80 points?
Well,
Right.
You know what they say in the Bible: pride comes before destruction. So
listen, you better talk.
Okay. All right. So we were talking about the prescription, right? Pay your bills on time. Keep your cards down. If you do run into hard times, make sure that you communicate. Realize that, you have about another 30 days after the due date before it hits your credit score. Not that we really want to be playing games like that, but it's good. It's good to know all your options.
Absolutely.
Now, I see something a lot before, and I don't know
if it's true. Go ahead.
So they say that, part of this whole balance of timely payments is, I guess, debt utilization.
How much? The utilization ratio.
Okay. How much you have, let's say you have $100,000, but you got $50,000 in debt. So you got $100,000 in credit, available credit, and you have $50,000 in used debt. So that's like a 50% ratio.
That's bad.
That's bad. Right. Why is that bad?
So, and we're talking about, and let's be clear, because we're talking about really the utilization ratio talks about revolving credit. And so, and I actually had somebody else, so revolving credit is not always.
What is revolving credit? Got it.
I'm Gary. Explain it right now. So Here we go. So revolving credit is things like your credit cards, okay? That the balance can be different every single month, and the minimum payment can be different based on what the balance is. Installment credit are things like loans, student loans, your car note, your mortgage, meaning it's a set amount of money every single month. Your utilization ratio talks about your revolving credit. And I actually had somebody that had 3 really good credit cards with low balances, but they had a home equity line of credit that was $200,000, and it was at like 199, something like that, because they used it for something. And their score went all the way down because that was considered still revolving credit, that line of credit, because the balance changes every single month and the amount that's due can change every single month. So for credit for companies, they do not like to see a high utilization ratio. So they like to see at least 30% or under. So what does that mean? I'll put it in small numbers. So let's say you have a $500 credit card, okay? $250, that's 50%. That's not good. Companies don't like to see that. They want to see that at maybe $100, maybe $150, want it to be 30% or under. And so I get people that come to me all the time and they say, I have a $300 credit card and I maxed it out to $299 and my score dropped. And they don't get the concept that I could care less if the credit card is $300, $500, $5,000, $50,000. I could care less. It's the balance in relation to the credit limit. The balance in relation to the credit limit. So look at the limit on all of your credit cards, and then you want your balance to be 30% or under. Why do creditors care about that? They don't like to see a sign of high utilization to lenders means that you may be financially unstable. That's what it kind of reads to companies. Like, if you have all this credit out there and everything is maxed, what is going on that you're not managing your money and managing your debt wisely? So if you're maxed out on everything, do you think they want to give you more credit? No, it's an indicator to them that there's something going on, that you can't manage your money. But when you're managing it at 30% or under, maybe 40%, maybe you're going back and forth, but you're not maxing things out, it shows that you're being responsible with money. What do lenders want? They want you to pay them back. They want you to pay them back on time. They want you to carry balances. They do interest. That's how they make their money. But they don't want somebody who is showing signs that they may get into default or signs that they are not managing their money well, because then they're going to take a loss, and they don't want that.
Okay. Now, you kind of led into my next question. I saw somebody recently on a famous talk show, and they said that credit card companies do not like it when you don't have a balance, when you pay off your balance every month. Is that true?
I mean, tick for tack. I mean, obviously, no. Why do lenders give money? Okay, so they're making interest. They're making money on the balances that you carry. But you also have to show that you use it responsibly, because that's how they increase limits. I mean, I'm still a firm believer that you can use credit to build wealth. You feel like I'm holding back?
Yeah, I feel like you're holding back.
Well, I'm not holding back, but I'm just saying it's a different perspective. I mean, they don't want it to be maxed out, obviously, because then they're not, it shows that you're not stable, but they do make money based on you carrying balances. But credit cards, and let me say this again, credit cards are not the only credit that you can have. I despise credit cards. I don't really, that's not, when I work on somebody's credit report, it better not be the end goal that you want a credit card. We're going to do, what are we doing for legacy? What are we doing for investing? What are we doing for wealth building? What can we do for this to be a platform for you to have long-term stability, period. I'm not working on your credit so you can get an Old Navy card or a Nordstrom's card or American Express or something of that nature. For what? Do that on your own.
So they can go shopping. They want to get the bag.
We're not, listen, people, the one, like I said in the very beginning, you funny guy. So like I said in the very beginning, part of the difference between, wealthy people and people that are building it and others and the average is what they spend their money on. So people who have a poor mindset, I'm not going to say poor, I said poor mindset, spend money on cars, furniture, TVs, things that depreciate. People who have a wealthy mindset spend their money on things that are investments, things that are income producing, things that have generate revenue, like businesses, like real estate, things of that nature. So what you're spending your money on matters. Period.
Okay.
Sometimes I even make my clients read. I've made clients read. You ever hear of the book The Millionaire Next Door?
Yeah, of course.
All right, so sometimes I even have people because I have people that make a lot of money and they do not look good on paper. And I have to say to them, why do you make all this money? And right? Right.
I have a lot of those.
Yes. And so, it's being an accountant. So a lot of it's about changing some of your behaviors. Changing some. This is one reason why I consider my service, well, I don't even consider. This is one reason why my service is different than all these other, get quick credit turn and get a collection deleted and get an inquiry deleted and all that kind of stuff. It's nonsense. This is one reason why my service is for people who are serious. My service is for people who want real results. My service is for people who want education. That's why you see clients post on my timeline all the time and realtors and lenders and things of that nature, because when done correctly, you can really turn somebody's life around. You can really help people, start funding their dream, having a house, have multiple properties. And that's really what it's about.
Right. Now, speaking about the client testimonials, right? So we have a friend in common, and I'm going to say her name because we both fight with her like cats and dogs. But listen, we talk about it.
Why did you say that?
So, Nicole Newman. Connected.
Hi, Nicole.
No. Yeah. So I want somebody to tag Nicole. Tag
Lord.
Nicole. Well, because I love Nicole, and I had to tell her.
I love Nicole too.
We fight like cats and dogs, and she's sung your praises. So
Amen.
The reason I brought it up is because if you can get Nicole to sing your praises, that means you are very, very good, because she gives everybody a hard time. So I see a couple of questions in the chat. I'm going to come to them all. Just give us a few seconds. And we're going to get some, because we got more conversation to talk about. So
yes.
I want to back up for a minute because there was something I forgot to ask, and I don't think we hit it. So people talk about getting these deletions. I've also heard people say that sometimes the deletions come back. Is that true?
That's true. It is true.
So you can get something deleted off of your report, and then it can potentially come back later on.
Right, and this is why. Go ahead.
No, I was going to say you pay the professional to do it, but it comes back. So, how does that work? You
didn't pay a professional to do it. But anyway,
shade.
So shade. So no, but the real reason is that usually when you so people don't understand. Let me answer this fully. So when people are writing all these letters, what you're doing is you're trying to maximize loopholes in the Fair Credit Reporting Act. Okay, the Fair Credit Reporting Act is what governs items being reported on your credit report. So there are laws and guidelines that were put in place because there are genuinely people that have identity theft, that have fraud. There are genuinely creditors that report inaccurate information. I'm dealing with a file like that right now where the client is 100% right and the creditor is 100% wrong. They may actually, they have a lawsuit. You know what I mean? So there are genuinely bad reporting, inaccurate information. That's why the law was put in place. So what a lot of people realize is that, the burden of proof is on the creditor. The credit bureaus report the information. The Fair Credit Reporting Act and the Federal Trade Commission govern the credit reporting. So that means that the bureau is responsible for reporting accurate information. The creditors then have to verify the information is being valid. Sometimes creditors just genuinely don't keep good records, don't validate the information the right way. They archive something and don't report in time. So there's all these different reasons. So people write a letter. Let's say a creditor just didn't give back in time. The credit bureau then must, by law, delete or cloak that account because it has not been verified. So they have to, because then they are liable for reporting inaccurate information. But
what was the term? Delete or cloak?
Cloak. Yes.
Cloak. What's that?
Cloak. Yes. So here we go. So when I worked for the credit bureau, there are times where we would cloak accounts. What does that mean? That means that I can still see on the back end from the bureau, but for whatever reason, sometimes it's a system problem, sometimes the creditor didn't respond in time, sometimes if there's something going on with that actual creditor, we will kind of hide it from somebody's credit report for a while until it kind of gets straightened out. So, but for consumer purposes, when the lender pulls your credit file, they would not see the account. Same thing as kind of like deleting it, okay? And let's say something gets deleted because a company does not respond in time. The law still says that the company can validate the information, they can add it back to your credit report, and the credit bureau then must by law notify you that something has been added. So this is a reason why I'm a huge advocate against all of these form letters and all these mass letters. If you have 8 million people sending the same letter to the credit bureau with the same information, the same font, the same everything, you don't think the credit bureau knows that it's not technically maybe a legitimate dispute and just you trying to get something deleted off your credit report? Like, really? So this is the reason why sometimes you will get things deleted, because sometimes the company went out of business. Sometimes they didn't respond in time. Sometimes you genuinely had a valid dispute, but it is false to think that you can have 20 negative accounts that are valid negative debts and write a form letter to all three credit bureaus and have everything deleted. If that really was the case, we all would have perfect credit. So the company, the real answer is knowing why the item got deleted. And if it was just deleted, let's say, for example, because they didn't respond in time, they can validate the debt and they can add it back to your credit report.
Okay.
That was too much. I was trying to give a full answer because I can go on.
No, if you got more, we'll take it.
I mean, this is why I just tell people, one of the things that I pride myself on is I have a personalized approach, meaning not one of my clients has the same plan, period, not one. And that's one reason why I get results. Is because I will say to them, when we sit down, I'm very transparent. I go through your credit report and there's 20 things on your credit report. Because I've been doing this for so long, I can look at the creditor, I can look at the dates, I can look at the amounts. It matters who's reporting it, how it's being reported, the dates on it, the amounts, all of that matters. And when I look at your report, I can say, this might get deleted, this probably not. We have 50% chance on this one, but I put together a plan whether the items get removed or not. I do it the right way. I say, okay, well, out of these 10 items, let's say 2 are removed. We have 8 left. We can possibly settle these ones. This one can still stay on. We have to build up here. I put together a whole plan to get you to your goal, whether 100% of your negative debts are deleted or not. Now, do I get items removed? Of course I do. But I work in transparency. So I meet with you one-on-one and I say, are all of these yours? If you say, Terry, yes, all of these are yours. Part of my job is to save you some money, because we may have to settle some items. But I also think it's going to negotiate a deletion with that settlement and save you some money. I just had somebody who had $6,000 worth of collections. We negotiated a settlement. She ended up paying $1,600 and she's getting her house.
Now I've heard people say that you shouldn't negotiate settlements because they stay on your credit report or something like that. I don't know, but I'm asking you that.
All that depends. So everybody talks about the 7 years. They take it completely out of context. The way the law is written is 7 years from the date of last activity. So what is last activity? It can vary. It can be the date closed. It can be the date paid. It can be when it was settled. So this is, again, why when you're working with amateurs, they just go ahead and either tell you to pay everything or they just dispute everything. But when you're working with an expert, I look at the account. I look at the date. I look at our timeline for your goal. If I need 9 months to work on your credit report and something is going to age out in 3 months, why on earth? Why on earth would I have you settle or pay that item? So everything is about strategy. Sometimes it may be paying a $600 item to get to your goal. Is it worth it? Absolutely sometimes. So this is about what is it you're trying to accomplish and then doing the work to actually get you there. So sometimes making a settlement is necessary, but then we're also going to save you money, make sure it's reported the right way, and possibly negotiate a deletion. If you had to pay $600 to get your dream house the very first time for your family to be homeowners, was that worth it? Absolutely. That was a good investment.
Okay. So, all right, let's talk about this.
Here we go.
How can you use credit to build wealth?
To be honest, what I said is use debt in a way that you're putting into things that produce revenue. So let me give you, I'm very pro real estate. I'm very, 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 very pro real estate. And
Why?
so, couple of reasons why. Number one, you have a tangible investment. So whether you sell it, whether you live in it, whether you rent it out, whether you flip it, you have something tangible that you can hold on to no matter what the kind of market calls for. But the biggest thing is because people always need somewhere to live. The people who own the land own the wealth. And so, you can get a mortgage, you can get a duplex, you can get a triplex. Let's say you get a duplex, $100,000 duplex. And let's say your mortgage is $1,000, which that's kind of high, but $1,000. But for purposes of getting the example out, let's say you rent out each unit for $800. Well, now you have a $600 profit every single month. But let's look at the whole picture. What do you have? Number one, you have an investment property. Number two, you have something that's going to appreciate in value. Number three, you have positive income flow. And then number four, you can pay down that debt faster because you're making more than the mortgage if you want to. You could possibly do a home equity line of credit and buy more property. So to me, real estate is a good way to have a multiplier. It's a good way to have something that's income producing.
So one of my favorite movies, well, I should say one of my more favorite comedies is Hollywood Shuffle. And the producer of that was Robert Townsend. And so the story goes that he used all his credit cards and maxed them out to produce that film. So what about scenarios like that when it's a business venture or, the movie is a business venture. I was going to say an artistic or creative venture,
right?
But it's something that he used to propel him. So would that qualify to the wealth creation process?
That was a calculated risk. If he had to do that, because that was the resources that he had good credit, he used it as a tool to leverage and put it in something that was going to produce more money. Absolutely. Now, do I say the average person should just go ahead and max out all their credit cards? No, I'm not saying that. But I'm saying even Robert Kiyosaki, he talked about when he first wanted to get into building wealth, Rich Dad, Poor Dad. If you don't know it, you need to read that too, Rich Dad, Poor Dad. And so he talked about when he was asking his rich dad about advice about building, his rich dad said, listen, I'm not going to teach you anything. Go and learn yourself. That's not my responsibility. And he talked about going to a course I'm not sure how many people. There was a bunch of people in the course, let's say 30 people. Okay. And the guy was talking about real estate. And they said, listen, research 100 properties and do a report on 100 properties over the next 90 days. Okay. And so 30 days in, half of the people had dropped out. 6 days in, 60 days in, more of the people dropped out. When they got to the very end of the 90 days, they said there was about 6 people left that actually took the time to research, and follow me, 100 properties. And he said that after looking at 100 properties, he knew exactly which property to buy. It was $18,000. It was a foreclosure. He made the phone call. He said, how much money do I need to put down? They said 10%. He said, can I put it on a credit card? They said, yes. He bought his very first property, the very first income producing investment property. That was smart. But what did I get out of that story? He took the time to do the work and research. Everybody just wants to jump in and be a real estate investor. Everybody wants to jump in and be an entrepreneur. Stop stop. You have zero money in the bank and bad credit. Stop. You have to learn how to manage your money now. Look, I'm sorry. You got me on a tangent. But you have to do some of the foundational work. I like shout out to Better Than Success and Nicole Purvey and Jabbar and that team, because I went to a mastermind class. Oh, Nicole Purvey, I love them. So I love them. And so I did Philly Real Estate Week last year, and I'm looking at doing it again this year. So love them. But I went to a mastermind class. I don't make them out to a lot of them because I have clients in the evening. But I like, because somebody had asked in the audience, well, how do I become an investor? And she was so real. She said, save some money, have some capital. You know what I mean? And look, and you're not even, because I know that your thing is cash. Everybody wants to be an investor. Everybody wants to be an entrepreneur. And you have zero money in the bank. You have to manage your money better and start having some kind of funds available.
Well, I mean, it's deeper than just cash, right? My thing is practicality.
Right.
While I'm a forever optimist, while I'm a forever idealist, I also believe when it's time, when rubber hits the road, you got to be practical. And so many times I run into people who have these big audacious dreams, but they don't have anything to back it up with. They haven't done the research. They haven't saved the money. They really don't have that great of an income, because, if you have good income, you can kind of work around some things. They don't have any of those things. And then I'll be honest, I take it a step further, and then many of them say, oh, the man is keeping me down. And I said, no, the man ain't keeping you down. It's many times it's your spending habits, right? That's what's keeping you down. But,
it's 1,000%.
Right. Yeah. I mean, I gotta, I don't even want to talk about that, because I get a lot of questions, and somebody's mad at me today, right?
And it wasn't me?
No, wasn't you. Listen, we gotta understand. And even if we disagree, we can still get to an understanding. But I think somebody thought I was trying to come at their neck, because recently I did a video talking about short-term thinking versus long-term thinking.
Yes.
And the people who usually want to take all the shortcuts and everything, I spoke to that, and I gave them that. So basically, they asked me a question about how they should file their taxes. Should they report something? And I took it as like they were trying to get over it. Now, they kind of came back and said I was accusing them of having short-term thinking, but the way they worded the question made it seem like it was short-term thinking. And I was just like, listen, because I want everybody to win. So I said, don't shortcut it. Just do it right. And people don't realize that taking the shortcut is short-term thinking. And a lot of times we're trying to cheat the process. And when you cheat the process, ultimately you're cheating yourself. Everybody's trying to get to the destination. Everybody wants to get to the bag or be the millionaire right away overnight. But they don't know what it's like you said, to research those 100 properties, go out and talk to 100 people, and then submit offers, and then submit offers to all those people.
And what? No, go ahead.
Rich Dad Poor Dad said, go look at 100 properties, put in 100 offers, you'll get 10, make an offer on one. And, people don't realize you have to do that over and over, and over again. And it's a process. It's not just a one-time get rich quick kind of thing. And that's where I see a lot of people get jammed up, and then a lot of people believe a lot of this nonsense and rhetoric out there. Like, I get called a hater a lot. So I'm the Bitcoin hater. I'm the real estate hater. I'm the credit hater.
Well, you're not going to be a credit hater anymore.
No. I'm not a hater of anything, right? What I am is, or what I am not is, I'm not into black and white scenarios. You hit on something earlier when you said everybody has a customized plan. There's no cookie cutter plan. There's no cookie cutter plan to develop wealth, right?
Right.
I'm into nuance. People like to say the devil's in the detail. I say God's in the detail, right? Because God will set you free, and so will the details. So I kind of flip that. But we got to get into the details. We got to get into the nuance and say, all right, is this a good deal or is this a bad deal? If you just say, hey, and I'm going to use real estate. Everybody knows I love the stock market, but I'm going to use real estate for this. So everybody says, hey, go buy a rental property. Well, every rental property isn't equal, right? Every property isn't equal. And so a lot of times when people say that to me, because I've managed property. I used to manage 50 units.
Location.
I've also had rentals. I've also flipped. And so I've done these things. I have context. I have perspective. And so people just say, oh, you're just anti. No, I'm not anti. I just believe in having all the information. And so I do find it refreshing that you're talking about using credit in a responsible fashion because, listen, OPM, other people's money, is very real. A lot of people have gotten rich or wealthy off of that. But again, you have to be responsible. Somebody in the chat chimed in and said you can be over leveraged, right? So what happens? Become over leveraged. I have a lot of real estate investor clients. I have developer clients. So what happens when you over leverage? So yeah, credit's good until it's bad. And then
the thing is, you have to be responsible no matter what. And sometimes you do. Listen, they say your blessings come from stepping outside of your comfort zone. You do have to take some risk, but it's about taking calculated risk. So when you are in a game where you're an investor, this is the one reason why you have to have some of your own capital. Because when you're buying these properties, you have to be able to carry that mortgage. Say there's a mortgage on there. Say you have a hard money loan, whatever it is. You need to be able to pay that whether you have tenants in it or not. You need to be able to, if you have a property and you expect the renovations to be 90 days and they end up taking 6 months, or the zoning doesn't go through, or all these other things that can happen. They don't go to closing. Somebody pulls out. There's a million, trillion, billion things that can happen with real estate. And so you need to take calculated risk. But this is why doing the work, doing the research, taking your time actually matters. And this is one reason why I like services, like the Better Than Success, because get around people who are doing it. Stop trying to just, somebody bought one house, another expert. Can you stop? Get around somebody who can tell you the good and the bad and the ugly, and then make calculated risk. But make sure you can carry those items before, because people get happy and they get excited and they just keep on going and going and going, and then you can lose it all. You can lose it all. So, go at your own pace. People come to me all the time about real estate. They say, what should I invest in? I want to do foreclosures. I want to do tax evasions. I want to be a wholesaler. And what I tell people is that stay in your lane. Find what works for you. For me, I'm not a wholesaler. I'm not a flipper. I'm not I don't do sheriff sales or foreclosures. That's not my niche. Just like you said, I like to buy and hold. I like to have properties and rent them out. And I'm able to make sure that I can carry those mortgages on my own when I have them, whether the tenant pays or not. But if you like foreclosures, fine. Let that be your niche. Then know foreclosures inside and out. Get with somebody who buys foreclosures. Have a process in place. If you want to be a wholesaler, then fine. Align yourself with other wholesalers. Learn the process. Do a small one first. Do the work. Everybody wants it to happen overnight. And you are going to sometimes have some bad deals. That's why you need to have your capital. I make sure I use your word.
Just to piggyback on that, sometimes I know you talked about stepping out on faith, and that's definitely important. Sometimes it's important to sit your behind down for a minute and reevaluate.
You ain't never lie.
And so, people don't like that because they think all action is actually movement. But we're always, there's action in being still as well. That takes effort. So, okay, so you believe in having people use credit responsibly.
Yes.
Give us a scenario of one of your clients. You helped them get through the process and they were either able to do something very wealth productive with what they did. Can you give us a scenario like that?
Yeah, absolutely. So I wonder if I didn't ask if there's a whole kind of thing about saying people's names. I want to say her name because she shared something on Facebook, so it makes me think that it's okay. But I guess it's asked in advance.
Because I never announce my clients unless they publicly say my name or they give me.
So she posted on Facebook and Instagram, but I didn't ask her purpose of it here. So I'll just give an example of somebody that came to a home buying seminar and was interested in buying a house and had always rented, and everybody in their family had rented, and just said, you know what, I would like to buy a house. And she didn't even start right away. She probably didn't become a client until maybe 6 months later or something of that nature. But to give a quick example, I'm very, very big on, owning over renting. Let me just give you a real quick segue. A condo that I have right now, currently in Brookhaven, the mortgage on it is $610. The tenants pay $1,400. So I just want you to hear that. The mortgage is $610. The tenants pay $1,400. A lot of times you are paying a ton more money to rent than if you owned that property. Period.
And what's the condo?
200.
Okay.
Thank you. Good question. I love it. But I will also say this: there's probably about 50,000 left on there, and it's worth over 155. And I haven't put any equity out of it. So anyway, going back, I'm sorry.
Can I have $1?
Whatever, of course you can. I love it. So my point is that she did the work. She invested in credit repair probably 6 months after she first met me and went to a home buying seminar. She did the work. She bought a single family home. Okay, she is paying, I think it's $365 less a month to own a single family property. And more importantly, now she's built other credit. She's looking at other things. She has been empowered to save some money. She's been empowered to use leverage. She's been empowered to be a catalyst for her family because now her son and daughter, I know definitely her daughter, maybe her son are also, who are millennials, are looking at buying duplexes, are looking at buying multi-unit families, properties. And she literally, with one transaction, has not only impacted, her financial life, her financial future, her legacy, her wealth building, but now she's empowered other people. And I want to say to you, and you know this, people miss the tax advantages of having a house. You can write off that interest a lot of times. So, and I won't listen, I'm not an accountant, so I'll stay in my lane, but I know.
But you're an investor.
Right. And so what I'll say is that there are also tax advantages to having a property. So she's paying $365 less a month. She owns a house, and she'll be able to take advantage of the tax advantages this year when she does her taxes. Win-win situation.
It is. It can be. It can be. But that's good. Have you ever had any of your clients use credit for business and or investment purposes?
Yes, absolutely. Absolutely. I mean, to be perfectly honest with you, if I'm going to be very transparent, I have clients from all, and when I mean all walks of life, I mean all walks of life. So loan officers, lawyers, a judge, a lot of professionals, because a lot of issues that I'm running into with, I would say, a good number of my clients is student loan debt. Student loan debt and things of that nature. And so people who want to be entrepreneurs, people are starting their business and have leveraged their personal credit in a way and gotten into trouble, and then, need to kind of take a step back. And so I have clients who, have franchise. I have somebody who has a franchise, or somebody who has daycares. I have clients that are doing some things, but they just need some help with their personal credit to kind of turn it around.
Okay. Okay. Well, let's do this. Let's answer some questions. I have some questions, and
Sure.
some of the things you kind of hit on, some of them you haven't, but I want to give everybody an opportunity. So, first question, Joanna Day asks, how long does bankruptcy last on your credit?
Hi, Joanna. I know her.
You're another real estate extraordinaire.
Yes, absolutely. So it can stay on your credit for up to 10 years. So 7 to 10 years, depending on the actual bankruptcy filing, depending on how you file. And just remember, for a Chapter 13, it may be like a 3 to 5 year plan. So for lending, a lot of times, let's say for a mortgage, most lenders will still lend to you 2 years after the date of discharge. So just because it's on your credit report for 7 to 10 years, depending on what chapter you file, that doesn't mean it's 7 to 10 years that you can't get credit. I actually have somebody right now who's there are some kind of builder accounts that you can get, secured cards, different things of that nature, that we started rebuilding right away as soon as the bankruptcy was filed. As soon as the bankruptcy was discharged, and now they're at over a 700 credit score, and we're almost at the 2 years. So as soon as we hit the 2 year mark, bang, he's able to buy his house. Okay. So I just want to impress about it. Usually most lending is 2 years after the date of discharge, even though it can be 7 to 10 years, depending on which chapter you file.
Okay. Next question. This is a little long one. So this is from Latia. Latia is a loyal fan and listener here.
Hi, Latia. So she says,
I hear it's good to use a HELOC to pay off your mortgage much faster than normal, especially if you have a plan to use it like a bank account and put all your income there. I'm not sure about that one. Can you speak to that?
Yeah, I'm not really sure about that one either, because it's really just a home equity line of credit, and you're borrowing from that home equity, like you're borrowing from that home equity to pay back. That doesn't sound.
I think I know what she's talking about. There are these, they call it infinity banking. Some people call it infinity banking, where they'll take a whole life insurance policy, and they call it something banking, something.
And Rashawn is on here. I'm sorry.
Many times they'll have people put money into a whole life policy. It's good and it's bad all at the same time. You have to know what you're doing when you do it. And what they do is they'll have you what they'll do is they'll have you put more of your money into your whole life account, use it as a savings account, and then they'll have you start paying off your mortgage because you can pull the money out tax free.
So it can all get very, go ahead. You're probably thinking the same thing I'm thinking. Go ahead.
Yeah, it's because I've seen some people do it wrong, and I do know some people that do it right. I'm thinking of one gentleman. I can't think of his name off the top of my head. Curtis Mays. Curtis Mays does it really
well. I know Curtis Mays also.
Yeah, he does it right because you're supposed to use mutual life insurance companies that pay high dividends that have low surrender. And so it can be an issue if the person doesn't know what they're doing. What did you want to add?
So I was going to say a couple things. So about the life insurance, like leveraging the life insurance, also it takes some time. So that's not going to happen right away, but I'm just not a firm. But so let me first say that I do also have a life insurance policy that I use in that way. And I'm projecting using, building up a certain amount of money in that and then putting it back into other things. And so there is absolutely a way, an option, but it's not a quick way. Okay. So it's also about what you're trying to accomplish and how quickly you're trying to accomplish it. But the other thing is that it can get very complicated. I would say that an issue like that is like an individual situation. Really look at, the rates, the amounts, the product, all those things. That's not like a blanket answer because it can get very complicated, but it can be done the right way. I'm not a fan of getting more debt to pay off debt. I'm a fan of using debt to have an income producing business, venture, or real estate, period. So I would rather put it into something that's income producing and then pull some of that out and pay down the principal.
Okay. Next question is from Mr. Robert E. Lewis, my man down in Texas. Robert is actually a mortgage broker.
Oh, hi, Mr. Mortgage Broker. No.
Can you remove student loans?
So if I could remove student loans, I'd be a multimillionaire, Mr. Lewis. So have I gotten, you said to be real. So have I gotten some student loans deleted? Absolutely. Have I gotten, but a lot of times it's because the companies, how there's different servicers, there's bad reporting, loans are transferred. So sometimes student loans can get removed. Sometimes the balances can get removed. But this is also a conversation where I work in transparency with my clients because I actually had this happen recently. And I said to the client, listen, it got removed from your credit report. That does not mean you do not owe it. It's the government. They will take your tax refund. They will garnish your paycheck. So I still need you to handle it. So there was through some loopholes where I actually had gotten some student loans deleted, but in good business ethics and in transparency and in credibility, I told that person, you took out that student loan. You owe that money. So make arrangements, even though now it kind of helped your debt to income ratio and you're being able to get the goal, pick up the phone and make some kind of arrangements. At least I don't care if it's $25 a month. Student loans are some of the easiest creditors to work with. If you give them something, they will not, kind of come at you full blast and take your tax refund and do, garnish your paycheck and send you to collections and all those things. But if anybody could guarantee the student loans will be deleted, they'd be a multimillionaire. It's the government. They will find you.
But if you need help with student loans, Sonia, the student loan doctor. Sonia, student loan doctor. I do
student loans with my credit repair.
You do?
Yes, I do. I don't have.
I didn't know that.
But now you know. So I don't have people come to me and then outsource for a bunch of products. So again, with my approach being personalized, if you have student loan issues, when you're coming to me for credit repair, I will walk you through the process and help you get that handled as well. Especially because I would say 70% of my clients come to me for home ownership. So a lot of times I need the student loans to be consolidated or income-driven repayment or something of that nature for their debt-to-income ratios to be in alignment with them getting a mortgage pre-approval.
Okay. That's right. I think Robert's trying to be funny here. So another question from Robert. So there's no magic letter to remove accurate information.
That is correct. So sometimes can you send a letter and get an item deleted? Absolutely. Is there a 100% magic letter that gets all credit deleted? Absolutely not. Again, everybody would have perfect credit and we would pay millions of dollars for that letter. It's just not true. Okay.
All right. Next credit. This is from Mr. Cassius Morris. Any tips for increased score? Currently at a 730, you have 18% utilization on credit cards. What else can I do?
1,000% depends on what else is on your report. Telling me you have a 730 and 18% utilization says absolutely nothing. So, what
Well, you
else
can
is
tell him.
on?
He's watching. He's listening.
Oh, all right. So this is what goes. So first of all, congratulations for having a 730. That's great, and having 18% utilization. But honestly, what are you trying to accomplish? So this is where people get into that debate. I have an 850, I have a 730, I have a 700. Listen, if you're over 700, you qualify for most things. So what is it you're really trying to get? Because you probably qualify for it. If you're just chasing a number, I would say for what? I mean, what else is on your file? But it shouldn't be. The real answer is what else is on your file. It depends. So what other debt is on there? Are there inquiries on there? Are there any late items? What else needs to be done? It really depends on what's on your report. But that 730 is excellent. You can get almost anything you want with 730 and 18% utilization. So I would maybe think about what it is you're trying to accomplish. And to be honest, you're probably already qualified. So good job, Mr. Morris.
That question actually reminds me of a call I got from my client. Called me up. He's a firefighter in Virginia. Makes good money, has a rental property.
Nice.
I want to say he's at like a 7 or a 725, and this was over 2 years ago. But he called me up furious, and he says, "Man, I've done everything in my power to get my score up to an 800. I'm at 725, and it won't budge. It's like I pay my mortgage on time. I've got a couple credit cards. I got a car. Matter of fact, he just paid his car off. He says, I don't know what to do." And so I kind of said the same thing you did. Like, what's your goal? What are you trying to do?
Right.
And I'm not a credit guy. And he said, I just wanted the number. I want 800.
Yeah. Wow. So and I'm going to go back to when we very first talked about scores. Remember I said that anytime you have a third party score, it's really just a guideline. He may apply for something and the lender, based on their criteria and their scoring model, say he's at 800. Do you know what I mean? So you're looking at these Credit Karma scores. These Discover has a score model. American Express does. CreditWise, Credit Sesame. Remember, those are all guidelines. Your actual score is not calculated until the lender actually pulls your report and the type of lender that it is. So you could actually be higher. So when somebody comes to me, let me just say this. I don't let any of my clients have a number be their goal. Yes, I'm going to say it just like that. Because we will be spinning our wheels. Is your goal, do you want an 800 for what? For a business loan, for a house, for a cash out refi? What is it that you want? Do you need a personal loan? Are there medical issues? What do you need that credit score for? I need you to define it, because I cannot get you to your goal if you don't know what it is, if you don't define it. Chasing a number is going to have you spinning your wheels all day long. It's just not necessary. If you're above a 700, 750, 715, you're pretty good. You're pretty good for whatever it is you're trying to actually accomplish. So I would, real quick, SMART goals: specific, measurable, attainable, realistic, timely. Instead of spending, you like that, right? You've heard that a million times. So, but I actually go through that with my clients, because otherwise you're spinning your wheels. There's other things to be worried about. If you're above a 700 and you have 18% utilization, you're doing absolutely great.
Okay. So I appreciate you being here with us, Terri, and sharing all your wisdom with us. But I got an official ask of you right now. Some fun, some light.
You did not say this in advance. Go ahead.
I didn't say what?
I said, whatever you're about to ask, you didn't tell me in advance. I'm scared. Go ahead.
No, listen, I got to keep a couple things tucked under the hat, right? So
okay.
I wanted to know, would you be willing to join the Finance Rebel Book Club and be a part of it? So we get together once a month, we read a book, and we talk about the book we read. And so the offer is also open to everybody else that's with us on this live. All you got to do is join the Finance Rebel Academy group, and we'll pick a book. I already know what the book's going to be. Terri mentioned it earlier. If anybody can guess it, drop it in the comments. But we're going to talk about that book. That'll be our first one. And I want to say we are going to do that. We'll start a month we'll say February. Wait a minute. Let's say February 15th. We'll get together and we'll just do a video chat like this, and we can all come on and talk about the book, because literacy is a big thing for me. Financial literacy is a very big thing for me. So, one of the biggest issues I see is we don't talk about money. And so let's get together and talk about money. It's totally free. I'm not going to charge anybody anything for it. But, I am looking for people to be engaged and actually do the reading. If you don't want to do the reading,
Right.
and you don't want to read the books, you're not really interested, don't just join just for the sake of joining. But again,
I know that's
come
right.
on over to the Finance Rebel Academy, and it's on Facebook. We get in there, we talk about money as pretty often as possible. Kev, I appreciate that. Thanks. Come on in. Oh, we got one more question.
Yes.
We'll
and let me just add, so I would love to be in the book club, and there's a saying that, people with a poor mindset have big TVs and people with a wealth mindset have big libraries. So I'm an advocate, a huge advocate for reading, personal, professional development, goal setting, journaling, affirmations, all of those things.
All right, so we're going to answer this question in a second, but if anybody can remember the book that Terri, she mentioned a couple books, but I want to see if anybody was paying attention, and put that book in the comment section. So, all right, last question of the night. What is the best course of action toward the purchase of investment property as a current homeowner? My concern is having two mortgages at once. That's a legitimate concern, April.
No, absolutely. That's a great question. So the first thing I would say is, when it's an investment property, normally you have some of your own money. It's not truly a full investment if you're 100% financing it and you already have a mortgage. So I would say the biggest thing is going to be looking at your debt ratios and making sure that your income supports both mortgages. It may even be better if you're looking at an investment property, is, like I said, pulling out a home equity line of credit or something of that nature, and then just buying a lower amount property just outright, buying something outright and not having to go through, a whole official, appraisal and inspection, all those kinds of things. So how can you leverage your current resources to not actually get a whole second mortgage? Can you get something for $50,000? Is your credit good enough to get a $50,000 line, something of that nature, and get it without getting two mortgages? But really, your income. Do you have money set aside, and will your income support both mortgages? If so, then go for it. But really, this is going to be really strategic about how your numbers and your debt ratios look on paper. It can be done because, especially for Pennsylvania, I think it's every 3 years you can qualify for like first-time home buyer mortgages, programs and things of that nature. So you can have a property right now and then 3 years buy a duplex or something of that nature. But it's really going to be about, can your income support that current property, the new property, and everything else that's on your credit file? Absolutely can be done. Just be careful. Be smart about it.
Gotcha. I wanted to share this because I thought the book was valuable, and he does mortgages all the time, and he's helped several of my clients with some things. So he said you should make sure your reserves are in place. 6 months for each property you own. You will also need 20% minimum for the down payment. I know sometimes the down payment might fluctuate, but since it's a non-owner occupied property, it's probably going to be more of the higher range. But that's good stuff. I appreciate that, Robert. But again, if anybody wants to join the Finance Rebel Book Club, search Finance Rebel in the search bar and just join the community there. It's private Facebook, not private. It's a Facebook group here that I moderate. And again, I want us to talk more about money. Okay, April says she's in Atlanta and have owned my home for 3 years. Okay, congrats.
Yes.
Hey, how you doing? Lissandra's my another one of my tax experts.
Hi, tax expert.
Compare notes, and then we talk about people with bad tax strategies all the time, or with no tax strategies. But again, if anybody wants to take part in a Finance Rebel Book Club, come on over to the Finance Rebel Academy. First book. I didn't see nobody put any comment in. So Terri, what do you think the book is going to be? You said it.
The Millionaire Next Door.
Nah.
Rich Dad, Poor Dad?
Yeah, we're going to rock with Rich Dad, Poor Dad. Now,
what?
Disclaimer.
Mr. Capital? Mr. Money is King? Okay.
Robert Kiyosaki actually says the same thing too. But he just says he likes having credit cards because he wants to leverage them.
Absolutely.
Right? So, dang, you made me lose my train of thought, lady.
I'm sorry. You said the book club's getting ready to start. The book that you're going to have, Facebook Live.
So I was going to say, just disclaimer, I think Robert Kiyosaki is great. I think his educational model is awesome. I don't agree with everything in the book. He's very heavy on creating corporations. I don't agree with that at all. I have seen so many people getting in trouble with that. So I want you all to keep that in mind, because I want to put that out, because I never forget when that book first came out. Everybody's calling me, I want to start a corporation. I want to start a corporation. And they don't realize the cost of starting a corporation. And there's also, but you have to maintain it. You have to maintain that corporation. Obviously, you want to be doing business inside of it. So I had people calling me that had no idea what kind of business they wanted to start. And they said, I want to start a corporation. So I said, no, that's not a good idea. But everything else from a philosophical standpoint, I think is dead on. And actually, I'll throw this out there. Robert Kiyosaki says that your home is not an asset. And I agree with that 100%.
Yes. Here we go. Well, I'll to piggyback on what you said when we talked earlier about Dave Ramsey and about Robert Kiyosaki. The real answer, honestly, is there's not a blanket way for everybody. Look at where you're strong. Look at where you're weak. Look at your assets. Look at your capital. Look at your finances. Look at your income, and be smart about what it is you're actually trying to accomplish. Put together a plan and then work the plan. But just understand that what works for me, what works for you, what works for somebody else, there's not one way to do it. So you can mix and mingle some of these strategies. No one's saying that one is right or wrong. There's just some that are better for other people, but they're also in different financial situations. And they're also trying to accomplish something different. So I guess one of my biggest takeaways with credit, with investing, is that, do the work, do the research, and put together a plan that works best for you, but also be very clear and specific and concise about what it is you're trying to accomplish, because you cannot put together an effective plan if you're not sure where you're trying to go.
That's 1,000% correct. There is no such thing as a cookie cutter approach. Even when you're baking cakes and using recipes, right? Nobody can follow the recipe to the exact T, right? You know how they always say salt till taste, or till it's to your liking. So money is the same way. Building is the same way. So I would encourage everybody to continue to learn, and I'm going to do my part to help promote that. And so again, everybody come join the Finance Rebel Academy so we can all join the Finance Rebel Book Club. So Terri, please tell everybody where they can find you. If you have anything else going on, any activities, any events.
Yes. So first of all, thank you so much for having me on. I enjoyed our dialogue as always. And you can reach me. My email is Terri, Terri, at caretools.net. That's CARE tools, TOOLS.net. I'm on Instagram as Care Credit Tools. I'm also on there as Terri Couser. My phone number, my direct phone number is 610-585-1726. So you can find me a lot of different ways. I have a bunch of seminars and workshops coming up. They're all posted on my Instagram page. So there's home buying seminar. I'll be doing something at Fridays. What is that? On Sunday, Monday. Look, I didn't have them all written down. I'm sorry. But if you go to my Instagram page, Care Credit Tools, you'll find all of the upcoming events. I'm doing a sister circle at a church about goal setting. That's on Saturday, the 19th at 12 o'clock. So a lot of different things. I like to be out in the community and I love to educate. So thank you very, very, very much. Good, healthy debate.
Wow, it was awesome. Yeah.
Thank you.
Thank you so much for joining us and spending a little bit of time with us. And I hope to have you back soon at some point.
Yes, absolutely. I would love to come back.
All right, everybody. Next week, like I said, we will have Dominique Thompson here. We're going to be talking about why it's important for small business owners to be on top of your human resources, how to work with contractors, how to work with your employees. Can't grow a real business if you don't have anybody working with you. You can't do it by yourself. So come back next week, 7 p.m. Wednesday sharp. Have a great night, everybody. Bye-bye.